Welcome back, my awesome people. In today's episode, I will show you how to create a great dividend paying portfolio. I will show you a breakdown of industries, the dividend yield expected from those industries, and how this can help you with your long-term vision of living off of passive income. The goal of a dividend portfolio is to build wealth through stock gains while earning a steady dividend income. Dividend stocks can provide investors with income as well as long-term growth potential. However, not all dividend stocks are great investments, and many investors aren't sure how to start their search. Newer investors often look for the highest yielding dividend stocks. They see a 7% yield as being better than a 6%, 8% yield being better than a 7%, and so on. But that's much riskier than it seems. A safe approach is selecting companies with more reasonable yield that consistently grow their payouts over time. And another safe approach is to hold 20 or fewer dividend paying stocks in your portfolio. So that way you can stay on top of all your holdings without being too stretched out. No point in investing in a dividend company that you can't keep track of. For myself, by using certain strategies in dividend investing, it has provided me with a dividend portfolio that has continuously beat the index. And when I am ready to start taking out my dividends for use, like 20 years down the line, the dividends I have accumulated over these years will allow me to draw dividend income rather than burn through my hard-earned capital. The way most people spend their money, they'll need way more than $1 million to retire. In fact, they'll need almost double that. No wonder so many people are working till they're 100 years old, right? But what if I told you that you can retire on a lot less, like 75% less? That's right, a fully paid for retirement on just about $438,000 dividend nest egg. Save up that much and you can look forward to a steady approximate $35,000 a year dividend income, which technically is right around the average annual income in the United States. And you won't even have to sell a single stock from your dividend portfolio either. Now, who wouldn't want to be earning $35,000 a year passively? I totally do. So bear with me now as I will be speaking in numbers. So this is how it works. The math on that dividend income is pretty simple. Your $35,000 a year passive income breaks down to just under $3,000 a month. To get that amount from your monthly dividend portfolio, you'll need a dividend yield of about 8% a year. Roughly speaking, someone who invests $1,500 a month in stocks would save up $438,000 in about 12 years, almost 13 years. And this includes reinvesting the dividends and getting the annualized gains that the market historically provides over the long term. If the stock market does better than its long-term average, you could get there faster. And once you get there, you can live off your $35,000 a year dividends or use that $35K as extra income on top of your 9 to 5. And there is no way putting your money in a bank will get you that type of return. So invest, my people. I will not be going to detail of each stock from each industry or highlighting the dividend yield of each single company, as by the time you see this video, the dividend yields could be totally different. So I will highlight a couple of stocks from the major industries that have strong fundamentals and that you should add to your watch list for long-term passive dividend income. And not only that, but the continuous company growth and the dividend increases, which will get to your $438,000 goal faster. But you will also reap the benefits of all the compounding that your dividends have done while you were building your dividend portfolio. And currently, as we are in a heavy bear market, you can get to the goal even faster by buying great companies for dirt cheap prices. The first sector that has been exploding in the past 5 years and will continue to do well in the future is technology. The future is pretty much technology based. Yes, it is down now, but technology companies will do great in the long term. So the two companies that I love from this sector is Taiwan Semiconductor and Microsoft, as these are my best bets in this industry. Second is financials. You can never go wrong with the financial sector, especially with banks making profits every year with their rate hikes, loans, and the many insurances that they offer. So the two companies in this sector that are on my watch list are TD Bank and Royal Bank of Canada. Third is healthcare. Since the pandemic, healthcare has taken a massive boost to its share prices and has greatly expanded its innovation of medical treatments. As such, two companies that will continue to do great in this sector are Johnson & Johnson and AbbVie. Fourth is industrials. As logistics, supply chains, manufacturing, and construction are the glue that keeps the world together through export and import, the two companies I love in this sector are CAT and 3M. Fifth is communication. With the rollout of 5G technology, global internet, and high-tech devices, communication will always be a part of our social life. So the two companies from the sector are AT&T and Verizon. I know these two companies are going through major restructuring, like AT&T, which I am a heavy investor in, and I am still buying into them. But once all the dust settles, they will boom. As these two companies are still the heavy players in the communication industry and are working their hardest to make their shareholders regain their trust. The sixth is real estate. Now, real estate has had its fair share of volatility and currently having its own crash with all the interest hikes. But regardless of the market, real estate has been one of the most reliable and stable dividend paying or monthly cash flow sectors in the market. As you may or may not know, REITs, or real estate investment trusts, are companies that own massive amounts of real estate and are obligated to pay 90% of their taxable income to shareholders as dividends. So you will see many REITs with incredibly high dividend yields, but don't chase the yields alone because many of them may also lack in fundamentals. So my two companies from this sector are Iron Mountain and Realty Income. The seventh sector is utilities and energy. This is pretty much a given. We will always need energy. Regardless of your views on gas or alternative sources, we will always need energy. So my two favorite companies from this sector are Enbridge and Dominion Energy. And finally, the eighth and final sector is consumer staples. This sector usually weathers any storm as they provide goods and services that people regularly need and use, like toothpaste and snacks. So my two favorite companies from this sector are Coca-Cola and Costco. So my awesome people, these are the 8 sectors that carry the weight of the stock market, and 2 companies from each industry that pay a great dividend, has great fundamentals, and continuously growing. So Jacob Rant, what does your dividend portfolio hold and look like? Well, my awesome people, my dividend portfolio holds roughly 10 stocks. Coca-Cola, Iron Mountain, AT&T, RioCan, Smart Center, ZWC, APR, Sienna, Retirement, HYLD, and ETHY. I am planning on accumulating more positions to diversify my dividend portfolio by buying during this incredible once-in-a-lifetime bear market. But for now, I am averaging down my current positions whenever I get the chance. When creating any dividend stock portfolio, it is important to include stocks from different industries to increase diversification and minimize risk. Think of it this way. A dividend portfolio is a 10+ year money-making tool as a result of buying great, reliable companies. And in 10+ years, not many companies will still be around as we are living in a very fast-paced and progressing society. For example, in 2020, how many of us thought that the transportation and retail industry will go through massive bankruptcies? So, diversification for a long-term portfolio is crucial to keeping your dividends steady. And remember, my awesome people, just like all the information I mentioned in my videos, assess your risk appetite, always diversify, and please do your own due diligence because I am just a clown on YouTube. Stay ranting.